Well, thank you, Derek, and I'm happy to be the first presenter after lunch, and our lunch presenter, it's always a wonderful time to present. Notwithstanding that, I'm going to talk to you about CMHC's underwriting and our criteria for mortgage loan insurance on student housing. CMHC is pleased to offer mortgage loan insurance to facilitate purpose-built student housing across Canada. We see the need for student housing on the rise, and it's under supply in most university and college communities across Canada, and we feel that this trend is likely to continue. So what I'm going to talk to you about today is our underwriting features, so what you need to provide to us in order to be eligible for mortgage loan insurance, eligibility, and our loan characteristics. So looking at the features, with mortgage loan insurance, we will insure up to 85% on construction, takeout financing, purchase and refinance of purpose-built student housing. These projects that support the need of student housing for publicly funded universities and colleges, and they can be located on or off campus. CMHC does recognize revenues per bedroom in determining the project's lending value and offers greater flexibility when the university or college is providing a covenant or 100% loan guarantee. So looking at the property guidelines, the mortgage loan insurance is available for multi-unit purpose-built student housing. I keep saying purpose-built because it's not intended for single detached either basement conversions or single detached buildings that are used to rent to students. The projects may be located off campus but must be within walking distance to the university or college. We defined walking distance as 2 kilometers from the campus. Units should be self-contained. So atypical units, which we consider as having 4 or more bedrooms, or non-self-contained units, or furnished suites can be considered if located on campus. We also require a replacement reserve when the units are furnished. So looking at new construction, so our guidelines, a market demand study is required to support the long-term financing of new construction projects. The study may be provided by either the borrower or a third-party company and should contain key factors such as enrollment data, projections as to the next 5 years. We also want rent projections, target market profiles in terms of demographics. We want current housing in the area, vacancy rates, rents, amenities nearby. We want a master plan of the university or college, and we need to know about the competition in the market. A market study may also be required for existing projects that have not stabilized yet. Looking at the borrower eligibility, so in terms of borrower, we want somebody who's well-versed in this industry. We heard from a lot of people this morning talking about how labor-intensive this sort of product is, and it is critical that they have at least 5 years track record in student housing. If not, we do want to see them contract out for a minimal of a 5-year term to a management company that manages these properties. The borrower or the third party must demonstrate adequate systems and controls are in place to manage leasing, rent collection, maintenance, vacancy, and bad debt issues. For new construction, in addition to the standard net worth requirements, the borrower must have the financial capacity to sustain 1 full year of operations, including debt servicing, assuming 100% vacant if the project's not ready for occupancy at the beginning of the school year. We heard about, Derek asked a couple of panelists this question this morning. This is reality. If it's not ready for mid-August, you're not going to rent up for September 1. You have to carry that property for a year. I don't know how many people have deep enough pockets to do that, but it's a concern when we're insuring these new construction projects for student housing. So looking at loan characteristics, the maximum loan-to-value ratio is 85% on purchase or refinance transactions. For new construction on the takeout financing, we will insure a maximum of the lesser of 85% of the lending value or 100% of costs. During construction, the loan may be advanced up to the lesser of 75% of value or costs, with the remainder of the loan advanced once the rental revenue has stabilized for that 1-year period. So looking at cash flow considerations, revenue will be assessed using per bedroom rents. However, CMHC will not recognize the portion of the revenue that is included as a meal plan. We do want to see 12-month leases in place. Supplemental summer revenues will not be considered in our evaluation. And it is the lender's responsibility to ensure the cash flows adequate security through, for example, prepaid leases, or we want parental guarantees, or we'd like to see leases signed on a joint and several basis by all the tenants. So that pretty much concludes my portion, and I think I'm handing it over to Sandy now.
Yeah, we're going to ask Sandy Harrington to come up and do a section now on conventional financing, and then we'll go to general questions.
Hi, Sandy Harrington, IC Funding. I've done, as Derek said, probably 100 of these properties over the last 15 plus years, somewhere between 5 and 50 million, a few more at the larger range these days. I'm just going to go through some of this that I prepared yesterday has already been covered this morning, so I'll go quickly. This was a project built over a number of years in Waterloo that Laurier University actually ended up buying. All the buildings you're seeing there, red brick, not a very good photo, but it gives you an indication of the style built at the time. And that client has moved on to a single complex village style, probably the most similar to the US style that you're seeing. It's not resort style, but there's 8 buildings in a cluster with amenity space at the front, 850 students, and it's fully leased for the upcoming year. It's worked very well. Some of this is all covered this morning, but what everybody's looking at, the lenders especially, you know, there's lots of room in almost every market except Waterloo. There's very little purpose-built in any other market except for Waterloo, and that's just because of the urban planning that was gone over this morning. That's really intensified, and a lot of developers were attracted to that opportunity. The international student market is also a huge component that people aren't paying, you know, full attention to, certainly on the lender side. The statistic, the latest one I heard was 36% growth since 2009, and the immigration rules seem to be softening to attract more people from overseas to come to school here. And of course that means that those people more specifically want to see purpose-built, close to campus. So if your child is going to school on the other side of the world, you know, where are they going to live after first year? It's a big, big issue. Some of the key issues that everybody goes through, try to look at stabilized underwriting. Vacancy has been so far a non-issue. It's just everybody is full in September. You're starting to see a little softness on the edge, probably more due to management than it has been to the market. But everywhere else it's running very full. They're also looking at sustainability. You know, it's not just about the initial rent up, the initial plan. When a building's brand new, that's great, it's got the sizzle. What's going to happen thereafter? Have they got a plan? Have they got a location? We don't see any models so far where they're offering food. In some of the larger urban settings, you're seeing it's considered, but it's a complication that most people in Canada so far just don't want to enter. They're keeping a fairly simple offering. And alternative use continues to come up each and every time, even though these are purpose-built, multiple bedroom units. They don't really look or feel like a regular rental unit. So you want to make sure that the location and the offering is going to be of continued use to students. That's the primary market. The secondary market is not something you want the lenders to really think too hard about, because it's not going to work very well. And these are more specific considerations for the lenders. Location, top of the list always. It's just, I hear the stories from the US models where they're at some distance with shuttle buses. Again, we're in the infancy here in Canada. As much as I've been doing this for a long time and taking my borrowers through the different cycles of available cash or not cash with the different lending institutions, almost all of them went to university. They remember what it was like where they were living. You're trying to model what they remember with what's being offered today, and it's a gap. So location is, they understand proximity to school. Another model is a stretch, and we're looking at some projects now that are, you know, on the edge of these distances. It's still only 1.5 kilometers, and the lenders are still questioning, is that too far? So you want to take away that question if at all possible, or you want to have a good story about why your location is going to make sense. The same thing as Paula was bringing up on the management side. During the construction phase, you know, who's going to build it, whether you have construction experience or you're hiring construction experience, the ability to deliver on time is probably almost more important in student housing than it is on budget, although the costs obviously in all construction projects are important. And through the monitoring program, that you don't see too much experience up here where people get offside on the cost side, but the delivery time is absolutely fundamental. Not many people are set up that if it doesn't happen for Labor Day, what are we going to do? You've got all the parents and the kids showing up on a long weekend, expecting to move into their units, and if it's not available, it's a big problem. And the reputation of that building through the school could last as long as those kids take to graduate. So it's not just even a one-year circumstance, it's something that's absolutely vital in pushing through. Did you start your construction on time? Can you perform on time? What's your fallback position as you get closer and you're not ready to deliver? So you saw a lot of different samples of design and scale. So far in Canada, most of the product has been very simple. They're seeing some amenity level now for sure, but because most of these buildings are built single building at a time, it's harder to fit in anything close to what you're seeing in the US. It's a cost consideration because it's only shared over the number of units, and we still have only had probably 10 or 12 buildings in the country built of 150 units, not beds, but units, you know, where you're getting 300 or 400 kids. There just haven't been very many of those big buildings that can afford the high amenity level. But that's coming now. We're seeing a lot more of those applications, certainly under consideration. We're also, you know, university is the primary markets because the college market up here is, we're building, my clients are building on some campuses now and adjacent to some colleges. Different consideration, you've got to be careful because it's a shorter duration education stream, different economics, different rents. It's not the same because you can build beside a college as it is a university. It can be done, it can make sense, but you have to be careful. Enrollment, again, some of these things for enrollment and the current and pending supply come out of the studies that you should undertake before you contemplate your construction project. We've seen a lot of projects that have started because they've got a piece of dirt, just as we just heard, and then they want to build something in the tightest time frame possible, but not enough consideration of where am I at in the food chain of supply and demand. It should be important to you and your money and your risk that you're taking. It's also vital to the lenders. A good story gets a good answer. We did a graph up just to do a bit of a sampling on what many people are striving for and where the lender gap occurs. The top graph basically is looking at a construction project. We just picked $10 million, so it was a simple number to understand. They're looking for 75% of cost, which is quite easy to achieve. Construction financing is actually easier and more available than the exit financing. So 75% of cost is a relatively easy standard, and they're going to expect $2.5 million of equity going in first. And that can be land value. It can be, you know, enhanced land value because you've got zoning in place that wasn't in place before. There's just some different strategies to achieve that. The challenge becomes on takeout, where a lot of people don't spend very much time when they're starting the project. They're just worried about getting it built. But at some point, you have to exit that construction financing. And the challenge becomes the next target would be 75% of appraised value. And the lenders push back on what that appraised value is, whether they're content to do 75%. And you end up leaving more equity than originally planned in the project, ultimately leading either to sale to another buyer at an elevated price that you can't get a lender to lend on because it's not lending value. and your equity gets stuck in the building, and it's hard to move forward with future development or to repay maybe family and friends, whoever got the investment money to begin with. So that's what's forcing a fair number of sales, because a lot of mezzanine debt is also utilized in construction. It fulfills the equity requirement, especially if they're doing more than one project at a time. And it can be expensive and hard debt to get rid of if you can't take it out on permanent financing. What I also want to just go through very quickly was a couple of loans that we have done. And just looking at the highlights on this, there was an appraised value of $6 million. The value per bed is relatively high. We have a loan amount of 72% of the appraised value. The lenders are going to push back. And that one was a push for a loan amount, so the rate was a little higher than elsewhere in the market, but he wanted the higher loan amount and was prepared to take that rate on a 5-year term. The next one is a larger project. Again, the value per bed was recognized as reasonable. It was appraised. The loan amount was based on what the borrower was prepared to take. That was within their range of comfort. And the rate was, it was a rate-driven deal for the best rate available at the time for a 10-year term. And the last one was a larger transaction. That the unique part of this was we did probably the first 35-year term loan in Canada, and it worked for the borrower. The lender had a block of money they wanted to put out, and they liked the project, and we did a 35-year term and amortization. And with that long of an amortization, it freed up a much higher loan amount than you would have had another way. So that worked for everybody. Thank you.
Thank you, Sandy.
Okay, so this is really a critical topic, but I realized something when Sandy was talking. Sandy, you're saying that you're getting mortgages at, 4%, 5%, somewhere around there, right? Okay, what's CMHC's 5-year lending rate today on apartments? Greg? Microphones for everyone, please, yeah. Just everyone grab your mic, we're gonna go quick here.
Is that okay?
Yeah.
About 2.25%?
Pardon me?
About 2.25% in 5 years.
2.25% today.
And
So
2, 8,
if
10.
you can follow CMHC's lending criteria for student housing, Paula, if we follow the rules that you just talked about, you're going to get money at maybe 2.25%, right? Or 2.5%, 2 3/4, something,
We don't set the
something
money.
like that. Right.
These gentlemen do.
Right. But you get what I'm saying here, right? So if you build 4 bedrooms, which everybody talked about today, great, Sandy can finance them at 4.5% or 5%. But if you build 3 bedrooms, maybe these things get
That's
financed
not
at
necessarily
sub
true,
3.
though. I was showing you examples of what was done at the time. I mean,
Right.
the rates are set today, so you have to
Right.
be fair to today's rates. I didn't break it all
What
down.
would those rates be, roughly? 5-year money?
Under 3, probably.
Under
Well,
3?
under 5, certainly. I mean, it's
Okay.
usually about a half to 3/4 point spread for CMHC.
Half
But
to
if you
3/4.
can't qualify for the loan,
Right,
you
right.
move to the next step.
Okay, good. All right, okay. So let's talk about valuation. And Dan, the first question is for you, okay? There's no purpose-built student housing in a marketplace. You're asked to come in and do an appraisal for the first building in the city. How do you do that?
Very carefully.
Yes, make it good. Okay.
What we've had some experience in the Waterloo market, and there've been a lot of trades there. So Waterloo, not only in terms of the product that's being built, but they've set the valuation model from our industry as well. We look to Waterloo and see the yields that they're getting. So we would probably go to a market where there is an established pattern of transactions, and then adjust for the locality where we may be, relative to Waterloo.
Okay, so pop quiz. You've got a site in, let's pick a city, Ottawa, to build student housing in. There is virtually no purpose-built student housing in Ottawa. How do you set the rents for a 4-bedroom apartment? You're going to come to Waterloo and then do what?
Well, we would look at pretty much rents subsume everything. They subsume location, they subsume the quality of the real estate, the location, and everything. So when we look at rents, that is really the barometer that we measure when we look at different markets. So if Ottawa has a $800 or $900 a bed per month and Waterloo $700, then we would make that adjustment. So it's usually driven off of the income that the property is kicking out.
Right. But we're talking now about pre-building this thing. That's the hard part. Sandy?
We've been working on this for years because, as you say, they weren't built before. They're living somewhere. The students are paying something somewhere. So you might take the most luxurious apartment in a house or whatever it was at the time, or apartments where they're 2 bedrooms and you say, well, this is what they're paying and now we're going to purpose build. And then you would go to another market and say, this is what they're paying in another market. So again, the US has a luxury of history, and that's the biggest problem we don't have in Canada, where everything is like 3, 4, 5 years old at the most.
Right. So let's we get asked this question all the time. It's a difficult question to answer. Easiest thing to do is just go to the condominium market, which isn't the perfect market. It's the newest product. Take the 2-bedroom apartments, just divide it by 2 to get a price per bed approximation, right? Then we go to CMHC data. We look at the proportional differences between a city. If one city's 600 and the other one's 800 on average, then that gives you some set there also. And then you go to the regular apartment business and you sort of pull all that information together and you knit it together, right? But here's the first thing to remember. It's not necessarily the city that's going to determine the rent. It's the parents, right? So if I've got one child going to the University of Ottawa, where rents are arguably going to be higher than they are in Hamilton, I'm still psychologically prepared to send the same amount of money in Hamilton as I am for my child going to Ottawa. Does that make sense? So it's not always set by the local rate. Okay, and Hamilton's probably a good example of a city where rents aren't particularly high in the submarket, but yet I think you can get strong rents there, right? They're not going to be as strong as Ottawa, but they might surprise you. Okay, all right. So let's go on to the next question, and this is a really important one, the question we get asked all the time. What is the difference, and I'm going to go with you, Dan, again first, okay? So, and then I'd like the rest of you to join in. What's the difference between the cap rate for a purpose-built student housing building and a purpose-built apartment building right beside it? So let's make it even simpler. You're at the gates of McGill, right? And you got enough land to build one purpose-built student housing building and an identical building that's purpose-built rental. What's the difference in the cap rate between the two? And make it good. Okay, Dan?
It's been our experience in the transactions that we've analyzed that you're looking at anywhere from 1/4 to 1/2, maybe a little bit more of a point higher for the student built than the regular multifamily.
Okay.
That seems to be the trend, although again, we've only seen a handful of sales that have that, established stabilized income pattern in place that you can reasonably extrapolate the return over.
Okay, Greg, so you're a buyer of student housing and you're a buyer of conventional apartments. How do you justify to your investors the fact that you're stepping this asset class where you're going to have a little more management?
Well, I would disagree with 1/4 to 1/2. Certainly, our view is you have to get paid we have to get paid a point. So if we were thinking new construction apartments or 5.5 or 5 1/4.
You can tell he's a buyer, right?
Well, we're a buyer, but we're transacting a lot of
Yeah.
stuff at those rates.
Yeah.
So, in our experience, you got to be at least a point, because otherwise to do it, you've got a higher price per suite. So you've got some convexity risk in the price per suite that you're paying. You've got to get paid for that. You've also got operational risk. You got to get paid for that. And you're doing a lot more work. You got to get paid for that. If you're doing it for 1/4 point, don't waste your time.
Yeah. Okay, so you're saying 100 bips on average. Okay, Sandy, any comment? This is a really important question.
Well, the lenders are going to come at it from a very conservative standpoint, and they're
Yes.
going to go off historical and leading edge. They're always going to take out the outliers, so that's the challenge. But you're certainly seeing, I think, at the lowest cap rates, it's probably 3/4. Although I respect what Dan's trying to do because he's got borrowers pushing him to say, give me the best rate because I have to get a loan amount. So it's a challenge.
Okay, Paul, any comment on that?
Well, CMHC cap rates are always a hot topic. We follow the market with our evaluation of cap rates. I would have to agree with Greg. We would look at it at a point to maybe even 1.5 over conventional apartment stock.
Okay, any other comment on cap rates before I give you the right answer?
Well, one of the things I was going to say also is that we don't see a lot of trades in really good high quality apartment product as well. So the volume of transactions, it's very difficult to get a specific number out of the market because it's in apples and oranges and the low volume of transactions. As we all know, as has been said here, and it's true in the U.S. as well, there's 10 or 15 buyers for every deal. And it's a pretty competitive market, and that just drives cap rates down, right?
Okay. So here's the way maybe to look at it, and I'd like you to comment on this. Let's assume we're at McGill again. Okay, everyone knows downtown Montreal, McGill's a great university, it's a great part of town. If you've got a student housing property in a purpose-built student housing building 1 kilometer away from the school, then I think I agree with Greg that maybe it's 100 points difference, okay? But as you move that property and the apartment building closer to the school, and now, Greg, let's move it to the gates of McGill. So we've completely de-risked this thing, okay? And you think about it, in a downturn, what do students do more? They stay in school longer, right? Parents will find the money. So I would argue that as you get closer to the gates of the school, that cap rate should go from 100 points to 0. Or closer to 0 anyways, right? So, but you understand the point I'm making. The further you are away from the school, the more the spread, the closer you get because of the fact that you're now de-risking this thing. Greg?
Again, it's a labor-intensive business. You got to get paid for it. And, you know, if you look at, you're going to buy purpose-built apartments and you're going to spend $250,000 per suite, and you're going to compare this to something where you're paying $400,000 per suite, you've got to take a little bit of, you've got a lot of potential downside risk on those large dollar per suite numbers. You have to get paid a cap rate premium. And also, if you're doing something which has got, you know, a higher numbers of suite or units per suite, there is no backup plan.
There is no plan B.
There is no plan B. An apartment building always has a plan B. So at equivalent spreads, I'd always be a seller of student and buyer of apartments on that spread. You have to get paid to do this.
Yeah. Sandy, briefly, anything more on cap rates?
Yeah, just, you know, a premium building, doesn't matter if it's regular multi-res or student, people are going to pay for it, whatever they have to in the market, and that's reflected for sure in what the rates are. And to be fair to CMHC, they look at their cap rates over the amortization period, like, because they're insured for the whole time. So they're really looking forward. They're not transaction-based, they're not a buyer, they're not a lender specifically today. They're looking over a long horizon, so you have to understand that when you're going to them.
Okay. Paula, what's an insurer looking for in a sponsor?
In short, deep pockets.
Yeah.
So we want somebody with deep pockets. We want you to have a track record in this space. We want a covenant of at least 25% of the loan amount. And like I said before in the presentation, if you do not have a track record in this business line, because it definitely is a business, we want you to partner up with somebody that has that or pay for that management expertise.
Okay, so Greg, this question to you. If we're going to build $100 million worth of student housing and you're able to borrow maybe $70 million or $75 million, that's a lot of money for the developer to make up, right? You've been entering this mezz space now on student housing. Tell me how you think through it and how you would structure a deal.
Well, so we're both buyers and lenders in this space. Our lending is really on two fronts. One is for developers who've gotten, you know, who want to keep, but may not have gotten the takeout finance they want. They need some kind of equity takeout. So we're looking at those kind of deals. But we've also got a number of people who are interested in building out in this space. We're long-term buyers in this space. So we look to provide people with great sites, you know, sites that we're interested in, with financing just above an equity level that will help them get the building out of the ground, stabilized, with a view that when it's complete, we'll take it on our balance sheets.
Okay, now this is a question that we're going to face both in student housing and conventional apartment. A lot of developers of condos are ideal builders for apartments and maybe student housing, right? They've got the skill set, right? But they don't have the leasing up experience that the traditional apartment owner is going to have and understand, right? They're used to putting up a trailer 2 years in advance, selling all the units out, and then going ahead and building it, right? How do you suggest that risk get mitigated, and how do you think through that piece? Where there's that lease up risk is that, you know.
Well, I'd say first you have to distinguish. People who are used to the condo market, they're used to selling their buildings well in advance. I know some of the American speakers who were on earlier had talked about this is happening more in the United States. The forward sale in Canada is still a pretty exotic approach to doing this business. And I think it's going to be very difficult to get buildings out of the ground on a forward sale basis.
Just define forward sale again for everyone, please.
If you're doing a forward sale, before you even complete or lease it up, you're selling the building to somebody else who wants to buy it, and they're basically buying it off the plan like you would a condo. I think it's very, very difficult to do something like that. So one of the great bridges that we have between buyers in this space, particularly apartment buyers like ourselves, is we're stabilized asset owners. We're not generally speaking, equity guys. And developers, you need some way to bridge the gap between the developers and you know, the ultimate buyers of the program. So this is one of the core challenges, is trying to bridge that gap between these people.
Okay, good. Let's talk a little about doing a feasibility study before you start building, right? What are the components that you want to look at in a feasibility study to determine if the marketplace is viable or not? Richard, do you want to maybe talk about that a little bit?
Yeah, I think there's a number of factors that have to be considered in the feasibility plan. I think obviously the demand on the demand side, projections at the university with respect to the program, both existing and longer term, as well as what the plans are for the university overall, if there's access to publicly available information around their campus master plan that gives you, typically publicly funded institutions will put this, make it accessible so that you have a long-term view of what their 10-year, 15-year plan is for the campus.
So I think it's fair to say there's a lot of data that exists by universities, and they publish a lot of it, and it's on their webpage, which you typically don't find when you're talking about rental apartments, right? You can figure out your demographic mix right down to the percentage of males and females on campus, right? It's all there for you. Okay, good. Any other comments from the panel about feasibility studies, either as a developer building or as a lender looking at a project to say, should I lend on it? What do you want to see in those feasibility studies to give you a comfort level? Sandy?
Well, I think it's really important that they get one done first. We see a lot of applications where it wasn't even considered, and we push back. Developers are prepared to go ahead, but they're going with gut feel instead of real numbers, and it's hard to persuade the lending environment that this makes sense, because it has to go through the chain for approval, and you've got to have a good story. And if you haven't carefully thought it through with real metrics, then it isn't carefully thought through.
Yeah, Paula, when we were at CMHC the other day talking to you guys, you had mentioned that, in the retirement home sector, when you first started getting feasibility studies, they were kind of weak. And as the industry matured, the feasibility studies matured, right? So how do you guys think through that piece on getting a book that's going to make the case here?
For us, feasibility studies, especially when it's new construction or an unstabilized project, it's critical. We won't look at it without one. As I did talk to Derek about with respect to retirement homes, we've been in this game for over 30 years now. And initially, we didn't have more than 10 or 15 pages as way of a feasibility study on retirement homes. Now we have something more than a Bible to read, sift through, with respect to all the proponents that go into one of these facilities, because it is labor intensive, as we heard from the panel. It is a business. There's turnover annually. There's many moving parts, and unless everybody knows how to oil and massage all those moving parts, it's going to fail. So things that we want to see, like I mentioned before, would be enrollment data. That's critical. 5-year projections, like people have stipulated, target market profiles in terms of demographics, current housing trends, vacancies in the area. So not even just purpose-built student housing caters to this clientele. It's all the housing in the area that's going to compete with this facility. We want to know about that. We want to know, like Sandy said, the master plan of the university or college, and we want to know about competition, anything up and coming in planning stages. So those are critical things that have to be in the feasibility study first.
Okay. Let me ask sort of the opposite question now. What are the deals that you don't want to finance? Maybe the three of you guys could just answer that. What don't you want to touch? Or where do you see a problem when a file lands on your desk? Greg, someone comes to you for mezz money, what don't you want to see?
A site and a dream. Yeah. And no capital. So, I mean, not to be facetious, but there's probably a lot of projects that land on our desk where there's no experience, there's limited capital. Those would be deal killers. Bad sites, another deal killer. We've been approached on stuff that's 3 or 4 kilometers away from a site. And saying, that's just, you're asking to get killed. So, I would say those are the top 3 things.
Okay, great. Sandy, you see a lot of these files?
Yeah, well, building on what Greg says, probably it's background depth of capital, and if you don't have it with your existing investor team, mezz debt is okay, but you're still going to bump into the same issue. So it's probably not a bad idea to get more patient investor money involved, and try not to be too greedy keeping it for yourself until you get some stability with a project or 2 under your belt of success, because the history of success gets you there, but you got to start with well-funded, that's prepared for things not working out perfectly.
Paul, any comments on that?
Yeah, two things I wouldn't want to see, and unfortunately we have. One is a dinosaur, and what I mean by that is a facility that was built a couple decades ago and can't compete with new things coming on stream. We've been in the space, not just student housing, but all rental space for a few decades now. With respect to dinosaur, we've seen in the retirement home community ward-style facilities that now would not be marketable. So when we're looking at student housing, we're trying to be forward-thinking and not just with amenity space and not with the pools, not the resorts that we saw in the States. Right now, we're not there yet, but we want to see things that make sense. So bedrooms with bathrooms and things like that are easy to market and proceed in a decade or two. Like Sandy said, we underwrite for a 25-year term, so we have one kick at the can to underwrite this facility, so we want to make sure it's going to be viable for the full 25-year amortization. That would be number one. The second thing that concerns us is, I think both gentlemen alluded to it, is the borrower, the strength of the sponsor. If they don't have deep pockets, if they're taking the equity out of the projects too early, if their pockets aren't deep enough and they're trying to sponsor up with people that don't have experience in this space, that would be a major concern for us.
Okay, great. I'm going to sort of combine two questions here. Where do lenders and borrowers' expectations differ most or significantly? Lender expects one thing, borrower expects something else. And what are the typical errors that you see in the student housing business cases that are brought to you? Greg, maybe you start because you're looking at these deals just go down.
I think what we certainly see on a couple of deals that we've looked on the purchase side and looked at the financing that was put on it. The biggest comment I'd certainly have is I think people have gone to put on financing that makes their buildings in many cases unmarketable to an institution. So I'd be very cautious about the types of financing that you put on your buildings, particularly long-term, that the guy who's next to the table, especially if you're looking to dispose of it, makes it very difficult to do so.
So you're saying if you're the developer, just do the construction financing and let you come and put the permanent takeout financing on it.
That's
because
right.
You'll get more money and probably with your strength, a better rate than the developer will get.
We will probably get more, but we take, generally speaking, less leverage. We do see some developers who are putting on permanent financing at higher levels of leverage, but they're taking the weights way up. And then they want to try and sell it, but there's no IRR because they've just killed it by putting on, 5% 5-year money.
Okay, great. Everybody get that? I think it's worth repeating if anyone hasn't. The financing is really important. The end buyer, Sandy, not if you sort of agree, can put more debt on this thing at the end of the day, and if he's a strong end buyer, he can get a better interest rate.
Yeah, I think to build on what Greg's saying, what some people are doing is, further to the graph I showed up previously, they don't really think about the exit. So originally they think it's going to be worth a lot more money, I'll get a great big permanent mortgage, I'll get all my money back out, and we'll all move on. The reality is they've probably borrowed some mezz debt, it's expensive, they have to pay it back, maybe they've got another project, so time is marching quickly. So they find out that their option, because they haven't talked to everybody they need to, like me, but anyway, they don't know what their options are. So they've taken whatever financing's been offered to them, and it's probably priced too high to sell to the next person, and they don't want to pay the penalty to get out of it, and it clouds your exit, which means you didn't really think you have to sell, and you're not financed appropriately.
Okay, good. Richard, any comments on financing from your perspective?
Yeah, I think another factor that's important is thinking about the geography in a broad sense from the Canadian market. So when you think about markets like Toronto or the GTA, Montreal, Calgary, Vancouver, the economics there and the view of risk in those markets is going to be very different than if you're thinking about Peterborough or St. Catharines or other markets. And I think that the brand and the strength of the university plays an important role in the overall risk profile of the project and the development. Again, if you're looking at building student housing in a city that has a well-recognized university brand and is well-recognized in Canada and North America, again, you're going to have a very different view of risk than possibly a second or third-tier university.
Okay, great. Now there's a few minutes left for questions from the audience. I'm not sure if we drugged the coffee or something, but we just have not had a lot of questions from the audience today. So feel free to come on up and answer them if you have one. Greg, I've got another question for you, because I really see, like, construction financing is available, takeout financing is available. This MES piece is really important, right? So at what stage should a developer be coming to you when he needs MES money?
Well,
And we'll take one from the audience.
so we see people coming in on 2 stages. Generally speaking, it's we've seen them coming in with, here we've got a site, what can we do? And I would say you're too early.
Yes.
Right? You've got to come in with a more fully baked plan. So we've got this site, it's tied up, here's our concept drawings, here's our, they've already got a rental study done. Like
Any particular company you like that does rental studies?
I can think of one.
Never mind.
But yeah, we want to see a lot of that research having been done first. Certainly we're open when people want to come in and want to talk about what kind of projects you're interested to buy. What are our core considerations? They're very short conversations and are very easy to have. But people approaching for financing before they've even tied up the site or got it under contract, have got a concept plan, have got any kind of approvals, is just way too early.
So you need a book with the properties under contract essentially, or purchased. Okay, great.
They need
Okay.
something ready to go, otherwise they're just too early.
Okay, great. Okay, Sam, you have a question? Just yell it out. Okay, it's a good question, so I'm just going to repeat it for the audience. So you will furnish apartments on campus, but you won't furnish them off campus. How come, Paula?
We will accept furnished suites if they're on campus.
Right.
Yes, and they will have to have a replacement reserve in place for that. Off campus, we do not allow for furnished suites, so if one does come into us, we will discount the furnishings off of our underwriting.
What's the rationale behind that decision?
So what's the rationale behind that?
We're not in the business to insure chattels, so we're in the business to insure, we're a Crown corporation, so we're to provide mortgage loan insurance for housing, not any kind of personal property, so we're just not able to.
And you've mentioned that if it is sponsored by, if it's an
Sam,
off-campus project that's
Tonsils
sponsored by
touching
the
the thing, yeah.
university,
A little closer.
what type of sponsorship are you looking for from a university toward a private investor?
So from the university, we'd like either 100% guarantees or we saw with a few deals, revenue guarantees, enrollment guarantees, anything like that. We can get, we've seen on various projects where there's tax exemptions for a certain amount of years, things like that from either the municipality or the federally or the funded university or college would be great for us.
Great, thank you.
Paula, if you see an application that's outside of what your boundaries are, could be 70% 1, 2, and 3 bedrooms, and they just stuck some 4 bedrooms in there. Is it just an absolute no, or can we bring that application, through the lender to you to look for an exception basis?
It's a good question, Derek. So what we try to do with a proponent like that or a scenario like that is we want some mitigating factors. So we would either want deeper guarantees from the proponent with a stronger net worth, maybe a reduced loan amount or LTV level, something to mitigate the differential of 4 bedrooms in the mix. So we will underwrite it case by case. It will have to go to our credit committee for final approval, but if you're willing to offer up some mitigating actions, then we can visit it. So that shouldn't be a deterrent. We will never, well, I should never say never, but at this point in time, we won't insure a transaction with the majority of 4s. I heard this morning 70% 4 bedrooms. Right now, we're not at that sweet spot. If you have a few 4s mixed in the mix and there's some comfort that you can give to us, bring it in.
Okay, great. So CMHC's put out a student financing policy a few years ago, right? There's been some take-up of it. But is that policy, could you see that policy changing or evolving?
Please don't.
Right now,
it's such an important part of the apartment business, right?
Right now, it's not going to change. We did a very extensive framework prior to actually announcing our policy. We've made a couple of errors in the past with insuring retirement facilities, and like I said before, they became dinosaurs because they were all ward style. When we came out with this program, we consulted a few firms to give us examples of good practicing student housing cities throughout the world and what's working and what's not. And we have a long-term approach because, like I said before, we are on the books for 25 years. So we want to make sure that ours is not a dinosaur 5-10 years out. So right now we're at a hold pattern on what our program permits for, but like I said, if there is a mixed bag and there are some mitigating action, we're willing to give stronger guarantees. It's very close to the university, maybe a lower loan amount or LTV. Let's talk.
Okay, so we're going to give you one more question, then I'm going to ask the question I'm asking all the other panels about sharing one piece of advice that you've never shared before publicly, okay? All right, so here, last question before we ask that. Do you think, to all of you, that the US-style luxury model for student housing is going to come to Canada? All the bells and whistles, fully furnished, things like that, right?
It's already here.
Yeah.
It's already here. It's limited, but I do think this is the growth space. I still do take a view that you have to be a little bit careful, that markets can get saturated with too much product at a certain price point, and our viewpoint has had to have a diversified price point portfolio.
Right. Sandy, US-style housing in Canada is going to work?
Yeah, we're seeing examples of it. I think there's some pushback from the lender world because they don't understand it. Again, there's no history on it. And I think what will happen is, from some of the people that are in the room and others we've talked to, the bigger players in the urban settings, you're going to see that model come because they can afford it.
Yeah, I had a real light go on when Jim Arbery spoke today. We've got to get the lending community understanding this space, right?
Yeah, just quickly, you mentioned that the takeout financing was readily available, and I would counter that. It truly is not yet. Some of the things that CMHC are saying, the regular lending world still isn't. We don't have a history.
Sure.
They aren't confident with it.
You're right.
It's tight.
I think I misspoke. You're right. Okay. Paula, US-style housing, just quickly. Yeah.
So we do like to see certain amenities, but where it comes to pool space and things like that, I still am a firm believer that here in Canada it doesn't work yet because half of our by the time you open the pool, it's summer months. So
yeah, for sure.
I think you really have to look into what sort of amenities will work and what's cost effective as well to put in.
Sure. Dan?
Well, I think, generally speaking, the U.S. has more wealth, obviously, than Canada, and so it will be somewhat limited, but I would also say that you should pick your spots. There'll be certain schools that could support it that have a tradition of wealth, like, my alma mater, Western. I wasn't one of the wealthy ones, but they have a reputation for affording the top-end stuff. So you really have to pick your spots and go to that market, as was discussed this morning.
Okay, great. Richard?
Yes, there's demand for it.
Yeah. I think that's a good answer. Okay. One piece of sage advice. Greg Roman.
That's a really hard question. Manage your risks, I would say. As bullish as I am about the space, we've allocated quite a bit of capital. About a third of our portfolio right now is dedicated to student, and we plan to increase that allocation. But I would certainly temper that some of the markets are getting a little bit too intensified. There's opportunities elsewhere, but I would certainly like to see risk mitigation strategies in most of the projects that we're coming.
Fair enough. It's still early days. As this business
It's
develops,
still early
there'll
days,
be better
don't go
brackets
crazy.
around that risk. Great answer. Sandy?
Basically the same thing. Good information gets good answers. The information just isn't full enough to get the answers people are expecting.
Okay, good. Paula?
I would suggest do your homework, know this asset class, know the space, and know the location before you would dive into one of these projects.
All right, Dan?
Well, mine's a bit self-serving, but I would say hire the appraiser sooner. Don't make the data, we often are put in a situation where we have to make the data fit the value. And if we're brought in earlier, we can work more with the developer to see where the numbers are going rather than expecting the appraisal to be a self-fulfilling prophecy.
Yep, I think unlike the apartment space, it's a forgiving business. If you overbuild it a little bit, you get the wrong mix, whatever, someone will come. In the student housing business, there's a fixed set of students over here, and you got to build the right asset the first time. Okay, great. Richard?
For the long-term investors that are looking to hold these assets, I really think that you should look for real portfolio opportunities with universities on campus. We're seeing a lot of universities starting to think very differently about their entire portfolio of residence assets. And they're looking at how they've owned them and managed them historically, and that may not be the best way to move forward. So we're starting to see some really forward thinking with university, certain presidents, certain departments within certain universities who are thinking very differently about their own portfolio, and don't overlook that. So as you're thinking about opportunities in a specific market, you're thinking about off-campus, a greenfield on-campus opportunity. Also think about portfolio opportunities with specific institutions.
You know, there are a number of universities and colleges here today who've kind of expressed that to me, that they're looking at building, you know, they need housing, should they go on campus or off campus? So it's certainly a dialogue that we need to have. Well, those are great answers. Thank you very much, panel.